Welcome to the Corporate Treasury 101 podcast. I'm Hussam.
And I'm Guillaume. In this podcast, we are going through the fundamental concepts of corporate treasury, which I learned from my experience working at a Big Four consulting company.
And he'll explain it in a way that someone like me who knows nothing about the topic can understand.
We hope you enjoy the episode.
So are there other instruments in derivatives other than forwards?
So indeed, there are multiple instruments. Forward is the most common one because the easiest, the most straightforward. Another one is what we call an option. This is the name of the derivative, the option. It functions more or less the same as a forward, except in that case you can decide whether to exchange the currencies at the due date or not. What does it mean is you're the shoe manufacturer. Again, this guy. You have these 120,000 US dollars that are arriving in a month. You arrive at the end of the month, and it occurs that now those dollars are not worth 100,000 euros anymore, but 200,000 euros. Like, huge bump. The dollars went up against euros like crazy. So you will make huge profit out of it. If you would have contracted a forward, you have no choice but to exchange those amounts of money against the pre-agreed rate. So the bank is now making a huge amount of money. If you take an option, you can decide to keep the US dollars and trade them at their actual price. So, of course, the option comes at an extra price. We call it the premium. You pay the premium to have an option. And there are other instruments such as non-deliverable forwards for restricted currencies. We'll get to it in another episode. Foreign exchange swaps, options with collars, etc. But let's keep those fancy, complex words for another episode. What do you think about all this, Hussam? Does it make sense? Is it clear for you?
So, I think the main thing I've taken away from all of this, Guillaume, is that all of this depends on, again, what you said right at the start, your risk appetite as a company.
Absolutely.
Right? So even deciding between a forward and an option, maybe you pay more fees when you have an option, but you have a higher risk with potential higher rewards.
Exactly.
Right? Versus forward, for example, is just super straightforward, super fixed.
It's in the name.
Low risk.
Yeah.
Right? But also low benefit. You don't reap any of the benefits in any case. So it depends what keeps you up at night. If that opportunity would have keep you up at night, like, I could have made so much more money out of it.
Exactly. But so again, that's a very valid point. And let's quickly rebound on this. It can become quite interesting for a company at some point. Let's say you're like $100 billion companies in terms of turnover. Like you're huge. The amounts of money we are talking about here are like thousands, hundreds, billions potentially of like what can be earned out of this. So you want to have an expert making sure you're hedging correctly, but also like making sure, okay, if really the exchange rate turns out to be in our favor, we want to have the option of buying it back. And then there is a whole financial world within the very company.
That's really interesting.
I think it is.